If you have been trading in the equity markets, if you started recently, then the last couple of weeks might just have been a baptism in fire. We've got you covered if you'd like to have some tips and tricks that you can follow to get better, though. Kunal Bothra is joining in. You are familiar with him because he's a regular face on ET Now. Kunal, thank you so much for taking the time and for joining me on the ET Money Show. I want to start by asking a very simple question, which is that a lot of newcomers to the market find it hard to differentiate between trading and investing. Is there a very clear distinction that you have to make when you decide what you want to be? Can you be both?
Well, thank you, Alex. Good evening for having me for the show. And I think you've raised a very important and a very basic question, which puzzles a lot of market participants. Now, I'll give a very simple example to try and simplify this. Imagine that there are two runners who are actually running a race. Now, one of them is more consistent. He's running at a comfortable speed, what we typically call it as jogging, and the other one is more of a sprinter. Now he moves in bursts of maybe high bursts of sprinting and then in periods of walking as well. So that's the basic difference between two different styles of running on the same track, and that's invest and that applies to same investing as well as trading. Investing is something which is more longer term oriented. There is typically a buy and hold kind of a strategy. You look out for good fundamentally strong companies in that regards, and then you hold on to it for the business cycles to turn in your favor, and then you try to ride the entire business cycles for each individual stock or a company in that regards. Trading is something which you buy and sell on a regular basis. So the idea over here for trading is to try and time your investments at a time when you know that the or you probably believe that the cycle is going to turn around for the stock, and your time frame is more short term oriented. So it depends on each individual goals for every market participants. Guys who are in from a longer term play, of course they would give more preference towards investing. But for traders and people who are looking out for more short term oriented returns, who have a slightly shorter term kind of a time span for themselves, I think trading fits the bill over there.
The other important question here is the time frame that you would spend. Because generally, when you're talking about investing, you're talking about the long term, and people like to think about this in terms of multiple years, right? You're talking about beyond 5 years as the norm if you're talking about long term investing. But if you're talking about trading, is it always intraday? Because I think that's what newcomers associate with trading. You make a quick buck in trading that is, starts at 9 o'clock and ends at 3:30.
Well, good question, Alex. And I believe trading is all about timing. But then, the time in which you trade is also going to be very, very important. Your returns depends on which time frame one looks at. So I've seen over my decade and a half of experience, traders who are looking out for minute by minute trading. And I've seen traders who have tried to time the markets and looked out for more of multi years of trying to hold the stock using technical analysis. So it depends on each individual style, his criteria, and his expectations of returns from the markets. My sense and my experience tells me that trading can be used for a multi kind of a time frame. So you can't restrict yourself just as an intraday trader. That's a misnomer, I would say, in the markets, that trading is only about buying and selling intraday, which you do on a regular basis. Trading is also used for long term trades as well, where you try and buy the stocks and try and time those stocks to try and give you good returns on a much more longer and higher duration period as well. The whole idea with trading is you have to have discipline in process, because it's a high professional, a high stress job when we look out for trading. So there are different styles of trading which one looks out for. You can be contrarian when the markets are going completely against one side of trend. So for example, right now when the markets are down, it makes a lot of sense if the statistics and the data points in your favor to go for contrarian trading. And there are times when it's much more better and to be safer to go with the crowd. That's what we call as trend trading.
Now, you mentioned a couple of times that timing is very important. For somebody who's just starting and who has decided that they want to trade, what are the key tools and cues that they should look at or use in order to get this right?
See, again, important and pertinent question, Alex. I'll break it up into four parts. That timing is all about trying to have a confluence of so many indicators coming together. I'll break it up into four parts. One of them, of course, is you try and understand the behavior of prices. It's not just the individual stock which someone is looking to invest, but you can try and look at price behavior across the peer group for the same sector, or across various industries as well. That's one basket which one should be looking out for. The investor sentiment, which is again a very important indicator. It tells you that whether you are with the market, against the market. And the third and the most important is looking at chart indicators. This is what we call technical indicators, which helps us give a precursor of what the prices could probably behave going forward. And last and foremost is actually the risk factor which is involved. So when you try and have a confluence of these four important patterns, the timing of taking a trade, whether it's on the asset class or on a stock or on an index, becomes much more easier. One tool which we basically use is for example, RSI. Now I've explained with a very simple chart over here of when I look at the last 20-25 years of charts for the Nifty. There have been two periods when the RSI has hit a very deep oversold territory. So as you can see on the charts, there are 2 points on the RSI, which is the lower grid. One was in 2003 and the other was in 2020. Both the points mark that the RSI has hit back towards a very important support trend line. And look out for, and what has happened post that is those points have actually turned out to be phenomenal entry points for someone who's a long-term investor. Now I'm using the trading principles, short-term techniques, and trying to extrapolate this into long-term. And that's where we derive, of trying to time the market. Now, the other way to try and time the market is you try and be with the crowd. So as you can see on the charts, when the RSI breaks a certain band, in this case a level of 60, is where we try and go long into those particular asset classes or stock. In this case, it's Nifty. In 2004-5, when the actual signal got generated, the Nifty was just around 1700 or 1750 as a price. And then once the exit signal came by for the index, in a span of 3 years, the index was almost at 4,700. So which means you've almost tripled your money in a span of 3 years just on an index. Imagine what one can do when you try and extrapolate this with respect to stock as well, where the returns are far more higher.
And in fact, just in the morning on Buy Now Sell Now, we were talking about a few stocks which have slipped into single digit RSI. So this is something that you can monitor on an ongoing basis. The next point that I would like to talk about is the mistakes that one makes, because clearly you have some tools at your disposal, but this is not necessarily an exact science, right? This is something that you develop over a period of time. Experience certainly helps, but people lose actual money, Kunal, doing this, right? So how do you deal with those mistakes?
Well, again, brilliant question, Alex, because my experience tells me that trading is a mixture of both art as well as science. So you have to understand the ground rules first. You have to understand that what is the arena in which you are trying to play, and then try and develop your own skill set, your own art. That comes with experience, and of course, with that experience, you tend to initially lose a lot of money. But then, if there are certain processes at play, you try and set up, then I think making money as a process becomes far more easier. Yes, you will have those periodic shocks in between where the market tries to challenge your thesis, but then if you are more of a process oriented individual, then the returns and the outcome are far more consistent and not random as such. So one of the basic my experience tells me that one of the basic mistakes which people do is to try and ensure that they don't write their winners, and they ensure that they write their losers quite a lot. So whenever, in markets, we say that if your finger gets stuck in the market, it's very important to be lethal enough and brutal enough to try and cut your finger, because otherwise your entire hand would probably be taken out by the markets. So it's very important to cut your losses first and then let your winners ride. It's very easy to say, but extremely difficult to follow. The other way to look at it is that when the markets are into a zone of a free fall like what we are right now, there are times where we don't overthink or overanalyze. We let the indicators come by, we let the market stabilize, and then try and look at or assess the market situation, and then try and look at parking money over there. The third and the most important rule, which again, it's taken me a lot of time and a lot of pain to try and evolve this, is to be more disciplined in your trading, be more process oriented. The moment you throw your sentiments and your emotions out, and then you be more process oriented, that's the time that you will be more objection, you'll be more rather than being more subjective in your decisions, you'll be very objective in your decision making. That helps you deal with ups and downs in a very cool and calm manner in markets.
Are there a few ground rules that a beginner should start with? For example, they should have trailing stop losses, they should avoid leverage trading, they should set aside a certain amount of money that they are willing to lose to trade. I'm asking because I know on a personal basis that you have gone through certain moments where you've questioned why you are trading in the first place, right?
Absolutely, and the first basic master rule which we apply for traders is that have a blanket stop loss for your entire portfolio, irrespective of what your thesis or your logic has been. Because at the end of the day, if your capital starts to get eroded, the lesser the capital you have, eventually the lesser the extent of risk-taking capability you will always be dealing with. So the markets can revive, the markets can come back again, but whether you can come back with the same extent and same guts, so that's going to be something which is going to be important. So what we do basically is have a blanket stop loss to the entire portfolio. For example, a master rule could be something like a 20% stop loss to the entire portfolio. The moment you hit a 20% stop loss, you just exit your portfolio, stay out for the markets for some duration, reassess the situation, whether it's a short term correction, whether there are better opportunities in the market, etc. The second and the most important is allocate your capital wisely. This is the biggest mistake which I've seen lot many traders do. At the start of a bull run, they would be heavily invested into large caps, but at the end of an uptrend is where 80%, or I would say maybe even 90% of the portfolio is eventually stuck into more mid caps, and I would say less mid caps and more small caps. And that's the extent of mistake which people they tend to do, because they run in for higher returns in a short span of time. Be more consistent with your trading. If you achieve 25 to 30%, for example, even on a short term trading kind of a process oriented system, that's a phenomenal return. All you have to do is try and achieve this more of a consistent basis, and that's all about it.
Thank you so much for joining in. I'm sure this has been very useful to a lot of people tuning in.